The market structure shift most traders miss. Most traders exit a winning trend one candle too early. Not because they're wrong about the trend. Because they misread the moment it actually changes. By the end of this lesson, you'll know the exact structural signal that separates a healthy pullback from a real trend reversal. Not a feeling. Not an indicator. A rule. You're in a trade. Price pulls back. Is this normal? Or is the trend over? Most traders guess. They watch price feel heavy and panic exit. Or they hold too long, hoping the trend resumes, and give back profit. Both mistakes come from the same gap, not knowing what a structure shift actually looks like. Why traders fail? Traders are taught to watch higher highs and higher lows. That's correct. But it's incomplete. They don't know which broken level actually matters. They treat every dip as a warning sign. Every bounce as confirmation. Without a precise rule, every pullback looks like a potential reversal. What would you do right now if price broke a recent low? Would you know if that mattered? Core concept. A market structure shift, or MSS, happens when price breaks a level that was protecting the trend. In an uptrend, that level is the most recent higher low. In a downtrend, that level is the most recent lower high. Breaking that specific level is different from a normal pullback. A normal pullback stays above the last higher low. A structure shift closes below it. This is the one line most traders never draw. Chart explanation. Picture an uptrend. Higher highs, higher lows, moving up in stages. The most recent higher low is the swing point right before the last rally. That level is your reference line. As long as price respects it, the uptrend is intact, even if it looks slow or shaky. The moment a candle closes below that swing low, structure has shifted. Which candle matters here? The close. Not the wick. The close. Entry rules. You don't trade the structure shift itself. You trade what happens after it. Once price closes below the protected low, wait for a retest of that broken level from below. Enter only when a candle closes back below the retest high, confirming sellers are still in control. That precise sequence is your trigger. Break. Retest. Rejection. Entry. Anything less is a guess. Stop placement. Your stop goes above the retest high. Not above the entire prior swing high. Above the retest. Why? Because if price reclaims that retest zone, your read on the structure shift was wrong. The trade is invalidated the moment that level is broken. A stop that's too wide protects your ego. A stop that's too tight ignores structure. This one respects both. Target selection. Your first target is the most recent swing low before the broken structure. That's the next area with resistance turned support acting as an obstacle. Your second target is the prior major swing low, if momentum continues. Targets come from structure. Not from a fixed number. Not from a feeling. What would invalidate this target? A strong bullish reaction before price reaches it. Trade management. Once price reaches your first target, move your stop to break even. This removes risk while keeping the trade alive for the second target. If momentum stalls, take partial profit. If momentum accelerates, hold the remainder. Discipline here means following the rule, not reacting to excitement. Invalidation. If price closes back above the retest high before your entry triggers, the setup is invalid. Do not enter late. Do not chase. If the market reclaims the broken structure entirely, the shift has failed. Stand aside. A failed structure shift is common. It's not a mistake. It's information. Common mistakes. Mistake 1. Trading the break itself, before the retest. Mistake 2. Using wick highs instead of closes to define the level. Mistake 3. Ignoring invalidation and holding after the retest fails. Mistake 4. Setting targets by emotion instead of the next structural level. Each of these comes from skipping the rule, not misunderstanding it. Live chart walkthrough. Here's how this plays out in practice. Price rallies, forms a higher low, then a higher high. It pulls back and closes below that higher low. Structure shift confirmed. Price rises to retest the broken level, forms a lower high on that retest, and closes below it. That close is your entry. Stop above the retest high. First target at the prior swing low. Price reaches that level. You move to break even and manage the remainder toward the second target. Lesson recap. A structure shift is a closed candle beyond the level protecting the trend. You don't enter on the break. You enter on the retest failure. Stops sit above the retest. Targets sit at prior structural levels. If the retest reclaims the level, you stand aside. Closing callback. Most traders exit a winning trend one candle too early, or hold a broken one too long. Now you have the line that tells you which is which. Mark your next chart. Find the last protected low. Watch what happens when it breaks. That's where consistency starts.